Good afternoon, everybody, and welcome back to the weekly market review for the week ending September 27th, 2024. We are at the end of, well, one day until the end of Q3, and then we head into the final quarter of the year, which is really wild. And the markets are in a really interesting position. We'll talk about it in just a minute, but I want to take a minute to remind you to hit the like button and subscribe to the channel. You can also follow me on Twitter at Mr. J. Thomason and follow my free weekly newsletter at befinanciallyfree.substack.com. And the links to both of those are in the description of the video below. So this is the on screen, the S&P 500 weekly performance. And what I thought was interesting was that almost every day this week started off as something of a gap up, except for I think on Wednesday morning we did not gap up, but we had almost all the other days we had at least a slight gap up. And what was interesting was the market gave it back. And I don't mean it gave it all back. Sometimes the market still ended up, but it definitely didn't stay near the highs of the day. And I just thought that was kind of interesting because the markets, in a sense, the markets should be all clear to go after last week. I know a lot of people have suspected that the Fed's 50 basis point rate cut is bearish, and it often signals. I mean, if you think about the 2007 and 2001 paradigms, which I have written about in my newsletter, those started with 50 basis points cuts, and it was bearish. But I don't know that it's the same situation right now. And the thing to remember is every single one of those first cuts, even the ones that led to those large drawdowns in bear markets, the initial rate cut was bullish, and for maybe at least a month after the rate cut, it was bullish. Even 2007, right before the great financial crisis. So, and what the market has basically been looking for since July, August has been signs of whether or not the labor market is cooling and whether or not growth is slowing down too much. And we've been confirming the last few weeks that the market is indeed a little slower. It's not as hot, but it's the growth is better than has been forecasted. And the last couple of days, we've gotten some data on that. And in the market, the Fed and the rest of the market has essentially looked past inflation now as a problem. Today we had a PCE release, and it was pretty much in line with expectations. But it was the consumer data, the consumption, the prices paid, incomes, and then yesterday the GDP and the claims reports were much better than expected. And so we're in a situation where like growth is still pretty good. So, but inflation is not anything to be feared right now. So it's kind of a Goldilocks scenario, and that should be good for markets. And now we do have kind of a pending labor market non-farm payrolls report next week on Friday. But this should have been a week. I mean, it was up, but it wasn't as up as it could have been. And it's kind of interesting because the positioning data up until this most recent time, this most recent update, the positioning data has been relatively favorable. Flows data has been relatively favorable. Sentiment was a little hot last week, but it kind of came off a tad this week. And things have generally been looking up. So I know today we had some news about. I'll talk about the Japanese yen and the what's going on in Japan in just a little bit. But we had some geopolitical tensions escalating kind of today. So that may be part of the reason for the negative close today. But it is kind of interesting that the market keeps giving back these large gap ups. Whereas it seems like it wasn't very long ago. I don't think it was very long ago that we would get the gap ups and then it would run. In fact, let me actually go to the Japanese yen futures because I want to talk about that for a minute. So obviously in the futures markets, you generally don't get those gaps because the markets are open essentially 24/7 through 5 days of the week. But This is about as good as you can get as far as like a gap like behavior. Um, so I talked about this last week that because of the failure on the yen, and we actually got a couple more, intraday failures and reversals in the time since the Fed day. So, um, I've been talking about being short yen, and I was kind of noticing all throughout the week it was just kind of puttering about, and every time it wanted to go down, below, we had this kind of support line or this support range, kind of in this area right here. And every time we got down to it and I thought we were going to break down, it actually came back up. And we're just kind of dithering about there. And then we finally, Wednesday and into Thursday, started to sell down. And then last night, it was actually pretty crazy. Last night, I'm getting ready to go to sleep, and the market's in the middle of bleeding. The yen market's a little in the middle of bleeding. And then no sooner, like I think I was in bed for maybe an hour. And of course, I wake up in the morning and I see this ginormous, 1.36% move followed by another 1/4% move up that happened in a span of 10 minutes. Um, and that was because there was an election to replace Prime Minister Kishida in Japan, and the market was thinking that the hawk, not the hawk, the market was pricing in the dove winning. I forget the names of all these people, but they were pricing in the dove winning all the way down here, and then they had a runoff, and the second vote led to a surprise victor by one of the hawks, who is more in favor of normalizing policy and raising rates. And so the yen just rocketed higher. And what I'm getting at here is that this is the kind of price action we used to see equities do until recently. So the market would push up really high on some event and then move a little sideways for a period of time and then just kind of grind higher and grind higher and grind higher. And you just didn't see that at any point this week. All of the gap ups in the market were, sold off, and they ended well below their highs. And so I just think that that's kind of interesting. Um, well, maybe I guess Monday ended, close to a little bit above where it opened up. But anyway, that wasn't a gap up uh, from from the week. So anyway, sorry for that. But uh, so anyway, that yen move was really interesting, and it's hard to say. Let me pull up the Nasdaq. It's hard to say whether or not the yen was part of the reason for that, for the sell off in the Nasdaq. If you actually look at the Nasdaq across the price action or across the week with price action, you just kept seeing all these quick pumps, and then it would kind of sell off, and then we had some pumps up throughout the week until Thursday, and then it just kind of sold off throughout the day. And then kind of the same thing today. We went up early on the, and then the PCE news was kind of the top of the day as far as the futures go today. So just not looking super good, but it is interesting because you know around that time where the yen moved up, like we saw a little bit of a sell off in the Nasdaq, but it recovered and made a new intraday high. So it's hard to know how much the yen, how much of an impact the yen had on that. The VIX, obviously, our close was high today. Not, I mean, obviously, it pales in comparison to that huge spike that we had on August 5th. We are still under 20, so not a huge concern right now. I think there's a lot of people that are getting a little bit too ramped up about volatility spiking up after this weekend. It might, I don't know, you never know, but it doesn't seem like that big of a problem at this particular moment in time. Um, One of the things I wanted to, let's see, what did I want to look at? The dollar. I was kind of thinking that we would get a bounce from the dollar, um, and that has not really happened. Although it's interesting to note that the dollar didn't close as low as it could have, despite the PCE data. But also, the dollar didn't do super well despite the growth data being better yesterday and the jobless claims data being better yesterday. So I think that's kind of interesting. To me, the big story was gold. So the gold positioning is outrageously long, and that doesn't mean that gold can't go up, but there's different things that you could look at. Like I look at futures positioning. Um, I also look at, or I also try to gauge sentiment. And yesterday on CNBC, they everybody was talking about, oh, you just buy anything that's precious metals, any of the miners, and all that kind of stuff. And I was just kind of like, that's probably a signal to maybe take a trade the other way. Of course, trying to short all time highs is, but the positioning data did support that. So one of the things that I was looking for was what would happen when the PCE data was released. I actually suspected what you would see was a little pop, and you kind of got a little bit of a pop, a $4.50 pop on the PCE, and then it sold off. So I look at this, even though we strengthened towards the end of the day, and I think that this strengthening had a lot to do with the geopolitical uncertainty. Despite that, the gold price, to me, this is a failure on gold, and I think that that's we might have seen on Thursday an interim top, not a long term top, but I could see us taking a little bit of a break on the gold chart from here. I could see us backfilling down to maybe around 2400 or 2450 off of this move. But who knows? It's anyone's guess. But I think that was an important failure today in the market. One other thing I wanted to take a look at was, let's see. So yields are coming up off their lows. That's kind of interesting. Um, I wanted to look at the 3 month, because this is one of the things I've been talking about with the cuts. I've moved all my cut zones down, so it's currently in the zone where the 3 month is pricing a 25 basis point rate cut. Um, we have until the very beginning of November to see this move. So let's see, right about there where the vertical on my crosshair is, that's about where the market will, at that particular spot, wherever the 3 month is going to be, got to be where the, that's got to be where the, that's going to show us where the, and I still hold by my view that the 3 month leads the Fed, that it's the best indicator of what the Fed is actually going to do. And so if we get further sell down, then we might actually see a much deeper cut than what they've been pricing in, which would be really interesting around the election. A couple other things. Despite the fall in prices today, breadth is up. Breadth closed at a new quarterly high on the stocks above their 50-day moving average. I remain convinced that we're going to see this go up and punch 90, at which point I'm going to be trying to use that in tandem with a few other indicators to see if there's any chance of pullback, correction, or anything else. We see also that we're near the top of the range in terms of the yearly range that we've been in when it comes to stocks trading above their 200-day moving average. So I think that's important to note too. Every time we've touched around this level, we've gotten some selling. So beginning of April, a little bit in May, definitely once we got into July. So that's something I'm going to be watching for to see how price reacts here. Any sustained movement above that level, and then I'll be watching for the 90 level to 95 level, which is around where we got during the euphoria